Okay, welcome back, ladies and gentlemen, to our final section pertaining to the financial statements and financial ratio analysis. In this particular video, we're going to hone our attention specifically on the financial ratios, what they are, where we derive them, what purpose do they serve, and more importantly, how can we leverage them or use them in order to help inform better organizational decisions. So first and foremost, I think it's important to understand exactly what we're talking about with ratios, right? And if you look at all, or if you've looked at any point in either during this course or in prior courses or on your own from a personal or professional basis, as an organization progresses through time, the financials within the financial statements vary widely, and for various reasons, both good and bad, internal as well as external. So what we've got to be able to do, though, from an interpretation standpoint, is get to basically what I determine or would call a baseline. Do we have any sort of comparability or ability to compare across years? And really, from our raw data, the raw numbers that we see in the financial statements, it's very tough to do because we might see a large growth in revenue, let's say, but we also might see a large corresponding jump in expenses. Well, then the question becomes, well, is that level of expense appropriate for the amount of growth we've seen in the revenue line? So to make a long story short, what we use ratios to do is basically to distill everything down into common size or like size terms so that we can do exactly that. We can compare from year to year, quarter to quarter, month to month, whatever the case may be, and make sure and at least have some degree of fidelity that what we're comparing is really apples to apples, and versus some other wild, crazy fruit. Okay, so at the end of the day, you're going to find that there are more financial and operating ratios out there than you can shake a stick at. Okay, I recommend taking a look at this particular site from within the healthcare industry. The Healthcare Financial Management Association offers this as a nice resource of basically a glossary of all the formulas, or at least many of the formulas. I don't know that we're going to get our hands around all of them, but I encourage you to take a look at this site. It's a great source to not only gain a little bit more understanding of the financial ratios, but many of the operating ratios that you see commonly used across the industry. Another great site that I recommend for all matters of finance is the Investopedia site, and they offer a very good set of materials pertaining to ratios. And you'll notice I've listed 4 broad categories here. I believe on the Investopedia site they offer 6 or 7. There is no quote-unquote right answer in this, because even as you go from organization to organization, a lot of the, especially internal ratios, can vary quite widely. Externally, though, we tend to see the same or similar set, many of which I'll cover with you in the next few minutes. So, from a very broad perspective, the 4 primary buckets that we're going to find ratios kind of falling into are profitability, liquidity, debt management, and asset management. First and foremost, organizations, creditors, vendors, individual investors, whatever, all want to know whether the organization is profitable. So that's probably job one. No margin, no mission. So that's one major bucket. The second one is liquidity. How effective or how good of a financial position is the organization in to be able to meet short-term cash requirements? Okay, and to meet cash obligations. Okay. Third one is debt management. How effective is the organization at using debt to leverage, finance, and underwrite growth? Okay, and are they using the quote-unquote right mix of debt and equity? In fact, I'll even put these quotes in here because really, what does right look like? Well, it's going to be highly dependent on your organizational leadership, highly dependent on the market conditions, your competitive environment, your payer environment. All those things are going to certainly come into play. So that's why leadership within the healthcare organization, especially financial leadership, can be somewhat daunting, because there is no quote-unquote right answer. It's basically a good or better sort of outcome, and largely we don't know that until after the fact. Last major bucket is asset management. Does the business have the quote-unquote right amount of assets for the volume of services that it provides? Okay, so we're going to slowly walk our way through each type of ratio. I'll give you a few examples, and then we'll kind of walk and talk through a actual data linked sort of scenario that hopefully you can see where some of these ratios are drawn from, or the numbers are drawn from, to be able to drive the ratios that we want to use. So first and foremost, our profitability ratios. We've got three listed here: profit margin, return on equity, return on assets, universally used across all industries. But it's also important, and this kind of goes back to some of my earlier discussions about how the financial ratios do not operate in a silo. You don't just talk about the balance sheet in isolation from the income statement, from the statement of cash flows. Okay. Here we can see, especially as we start to dig into where the data is drawn from, how in order to derive these ratios, we have to draw from more than one financial statement. And typically what we're drawn from is the income statement and the balance sheet. Very few, although there are a couple, ratios are data that's driven or derived from the statement of cash flows. So the balance sheet and income statement are big too. First and foremost, profit margin, net income over total revenues. Net income, obviously, income statement, total revenues as well. Return on equity, net income, of course, coming from income statement. Total equity now coming from the balance sheet. And return on assets, same sort of thing, income statement and balance sheet. Okay, so our liquidity ratios, we start, and some of the more common ones are listed here. The current ratio, the quick ratio, the interest coverage ratio, or what sometimes is called the times interest earns, ratio, as well as our days cash on hand. Now, the current ratio, again, very commonly used, basically just looks at our total amount of current assets over our current liabilities, or how well are we covering, or how many times are we covering our current liabilities and basically payment obligations. Okay, the quick test ratio often will be termed, you'll see it termed as the acid test ratio. Okay, and that harkens back to the days in mining, where in order to get the gold out of the very hard igneous rock, miners would actually take acid and burn the rock away from the gold. Of course, gold's a noble metal, and it wouldn't interact with the acid, but the rest of the rock would. So this is basically what we're trying to do with our quick ratio. After we extract away this, what is commonly a problem across industries, this issue of inventory. Okay, inventory, even though we list it as an asset or a current asset, as we've talked about in prior modules, that asset typically takes a fairly long period of time in order to turn back into cash if we need it. So we strip inventories away and only look at cash, marketable securities, and accounts receivable, and then divide that by our current liabilities. The larger difference you see between these two ratios, the more of an issue that we have in terms of inventory control, supply chain, that sort of thing. That's certainly worthy of leadership attention. The next one is interest coverage, or our times interest earned ratio. That is our earning before interest and taxes, if you haven't seen that term EBIT before, divided by our interest expense. Essentially, how many times does earnings cover our debt service obligations, okay, and the amount of interest that we owe on all forms of debt. And last but not least, days cash on hand. Here we get even a little bit more stringent in terms of the actual cash that we have, even when we have issues, and many organizations do have issues with turning accounts receivable into cash. In fact, in the healthcare industry, the average is about 53 days at the last data point that I've seen. So here we strip out even accounts receivable and then divide it by our basic operating expenses after we back out depreciation and our allowances for bad debt. So how many days of cash do we have available to us to meet our operational expenses. So good liquidity ratios. Next one is debt management, or oftentimes you'll hear them called or referred to as leverage ratios. They measure the amount of borrowed funds generated or used to generate returns. Okay, big one that we often hear is the debt ratio, which is our total liabilities over our total assets. Okay, our long-term debt ratio, of course, is focused on our long-term debt divided by long-term debt and our shareholder equity. Okay, and we can often see that framed a little bit different way with long-term debt over total assets. And our debt to equity ratio, okay, total liabilities over shareholder equity. What's that mix? And again, same as what I've said before, that mix is highly subjective based on the organization and the individual internal and external characteristics. And last but not least, our asset turnover ratios. Essentially, we don't want to see non-productive assets. We don't want to see idle assets. We don't want to carry assets on our books that aren't actually moving and continue to crank out returns for the organization. Okay, those assets need to be sold, need to take that cash and reinvest it into the business in areas where it's actually going to be productive. So that's what the asset turnover ratios are really trying to drive. The big one that we often hear referred to is our not only our fixed asset turnover, or our FAT, our total revenue divided by our net property, plant, and equipment, that's PPE, and total asset turnover. You're going to hear about this later in our DuPont calculations, where we take our total revenue divided by our total assets. And last but not least, days in accounts receivable. Our net accounts receivable divided by our total revenue divided by 365. Sometimes you'll see this as a 360 number. As long as the organization remains consistent, we're in good shape. So just to follow along, a little bit of a fictitious example, pulled this out of an MBA textbook and repurposing it here. So don't get too wrapped around this concept of sales, cost of goods sold. Okay. Really, what we're really talking about here is being able to get down to our earnings before interest and taxes, our EBIT line. But just wanted to give you a kind of a reference point to be able to draw numbers from, so that you can understand where the data comes from in order to generate the ratios that we're getting. So here, of course, primarily our income statement. Okay. Next one is our balance sheet. Okay, and as we start to dig apart, or basically separate these financials, just a couple of very kind of fundamental data sets, if you will, for lack of a better term. Here we can look at our current ratio. As we look back at these sheets, our current assets over current liabilities. So of course, here's our where's our current assets? Right here, turn on 143, okay, and current liabilities over 64. So that's where we get our 2.23, and this particular company was called Davies Incorporated. It's not really meaningful at all, but how now we can compare this particular company at 2.23 against their peer group average of 1.80, and we can say, at least on this particular ratio, the organization is doing better than the peer group average. Acid test ratio. Remember I said that we subtract out marketable securities and inventory. In this particular case, I don't believe we've got marketable securities listed, right? So what we do is just then take what we've got in terms of our cash plus accounts receivable. So 20 million plus 36 million. Here's our 20 million plus 36 million. We subtracted out our 84 in terms of inventory. And divided it by our current liabilities, which of course we've already seen, and look at what we've got here, a 0.88. So here's an example of an organization that might have a bit of an issue with this inventory line. Okay, so we might want to be asking a question about, why are we carrying $84 million worth of inventory when we're only generating, or only have $20 million in terms of cash and accounts receivable together. Basically 2/3 of what our inventory actually is being carried on the books as. Okay. Average collection period, accounts receivable divided by daily credit sales. And I won't keep going back and forth here, but you can hopefully see where we can derive each one of these numbers, right? And the key is to all this is, okay, so we get our ratios for this particular year for this particular company. Yes, it's nice to be able to bounce across and look at our peer group average, and I'll tell you a couple different sites later where that can be drawn from. But really, these ratios are only so useful, right? We want to be able to take these ratios, and here's we have our operating profitability ratios and some of our financing decision ratios, return on equity, market value ratios. We want to be able to take some of these and look at them longitudinally across time, right? We want to know, well, is the organization getting better or worse? When we only look at a single financial ratio, let's say the debt ratio in this case, 53.7%, when our industry average is 35%, well, this doesn't look too good, right? But maybe last year when we calculated this ratio, it was 65%, right? And we've been able to reduce it to 53%, okay? So what we want to be able to do is look at these ratios over time and determine, okay, are we getting better or worse? So what that implies then is we're going to have to look at, for any good organizational analysis, and that's one of the reasons why I'm asking you to do it for this particular class, is I want you to calculate these ratios and develop a trend so that you can understand, okay, from the debt ratio perspective, is it going up, is it going down? And then the so what question. What does that really mean for us? Should we be concerned? Should we not be concerned? And why? Okay? So hopefully these few slides will help you kind of understand not only the ratios themselves, but also where the data is drawn from, so that you can do or start to use this as a basis to be able to move forward in your own organizational analyses. So this next slide kind of touches on exactly what I was just talking about. We want to be able to look at these ratios across time, and we want to be able to look cross-sectionally within the organization and across organizations with respect to benchmarking. Okay, so this is another just example where we can say against the industry, we're looking at the current ratio in this case, what's happening with this organization. It looks like their current ratio is kind of bouncing around a little bit, but on a general downward trend. So then the question, of course, is why is this happening? What's going on that we're losing this position and we're suddenly below the industry average with respect to our current asset strength? And more importantly, what do we do about it and how do we reverse that trend? Likewise, here we have the debt ratio, same sort of phenomenon where we've got the debt ratio goes up and then has this general downward slide, which in this case, we're getting back to our original position we had back in 2011. And we're now lower than the industry average, which in this case might be a good news story. We're using less debt and we're not as exposed or as risky or perceived to be as risky within the capital markets. So that's another thing that I really haven't mentioned. We not only have to understand how to derive the ratios, we need to understand whether going up or going down is a better position from a financial standpoint. So don't assume that everything going up is good and everything going down is good or bad. We need to understand that, if I see a particular ratio going in a particular direction, okay, so what does that mean? And, more importantly, is it something that is going to be a good news or bad news story for the company? Last section here I want to talk about with respect to ratios is this topic of the DuPont analysis. Textbook talks about it, and it can be a pretty useful tool that essentially helps us to basically break apart this topic of return on equity. Okay, now equity, of course, primarily we think about this as being a return on shareholder equity on the for-profit side, but I would argue it's equally as important on the not-for-profit side, because when we have donated capital and we have donated funds from the local community, we want to make sure that we're being productive with them, right? We want to make sure that we're maximizing return to the community from those funds, wherever their source actually was derived. So the DuPont analysis basically relies on three segments: total margin, total asset turnover, and the equity multiplier. Okay, total margin, of course, we're looking at expense control. Are we actually creating a separation between basically revenues and expense? Total asset turnover, as I mentioned before, really looks at asset utilization. How many times are we able to basically generate a dollar off of our total assets? And last but not least, it's called the equity multiplier, but really how well are we using this mix of debt and equity, and is it really helping us to catapult the organization into a higher level of growth or higher level of productivity? So another way to look at it is, and you'll hear it framed this way, earnings, turnings, and leverage. Okay, and more specifically, what we can look at is that total margin, total asset turnover, and equity multiplier all being able to multiply together for our return on equity calculation. So just for simplicity's sake, total margin can be broken down into net income over total revenue divided by total assets over total equity. Now, if you notice, right, these can cross cancel, right? So really we're talking about net income over total equity, which of course is the return on equity calculation, but this just helps us to divide it out into and separate it so that we can more clearly identify where our problem areas are in terms of both growth or decline, whatever the case may be. So as we look at a couple different years of fictitious data, we see a sizable jump in total margin, and pretty stable amounts over here in the asset turnover and equity multiplier lines. So of course this is the source for our overall jump in return on equity from 2.4 to 7.9, almost 8%. And of course then we can also use these to compare across industries or across our industry where we stand in each one of these areas, so that we might understand where to go to find best practices or leading practices, as well as different ways that we might want to remedy or showcase, to specific board members or leadership team members where we're doing stronger or weaker, and some of the reasons why. This slide I just added in there to give you a little bit more background on each one of these. I don't want to insult your intelligence and read it for you, but if you need a little bit more background on what each one of those components are, as well as what they do, there's some additional information for you. Now, I will tell you that there are some limitations to ratio analysis. Several of those are listed here. Depending on how much faith you put in our accounting systems, there are some issues with regards to, even under generally accepted accounting principles, you do have differences across organizations, which of course can affect their financial statements and how those numbers can or should be interpreted. Okay, and secondly, the industry averages, peer group averages, are only approximations. Sorry, getting late, it's getting tough to speak. But we need to make sure that we're not putting all of our eggs in one basket, so to speak, and just kind of take these averages with a grain of salt, no matter what the source might be. We also need to understand that an average is an average. An average, when we start talking about grade point averages, is a C, right? Sometimes we don't want to be shooting for a C. We'd rather be shooting for an A-level rating. So the average is probably not where we want to be targeting. I mentioned this about accounting practices. A higher low ratio doesn't automatically lead to a specific conclusion. You will find as you start to look at ratios across an organization, some are going to be pointing in a positive direction, some are going to be pointing in a negative direction. The difficulty is in interpreting those changes, those adjustments, and helping to explain why they sometimes are telling us two different stories at the same time. And we have to be careful about seasonal fluctuations and bias, and as we see the ebb and flow, especially when you start talking about commuter communities. We start talking about any sort of seasonal fluctuation that will affect the local economy with job layoffs and job rehirings. all that kind of stuff really can skew our data depending on when the measurements are taken, especially as you look at a month-to-month or quarter-to-quarter type of comparison. If you're not careful, you can start to jump into decisions that maybe you shouldn't until you have a really good understanding of the fluctuations within the local market. Okay. Now, of course, depending on the organization that you work in and that you're involved with, you will see many of these ratios and many of these operating indicators displayed, used, and often referenced back to within the key performance indicators and dashboards that we use in order to keep track of such things. Typically, you're going to have, at least in my experience, we had a balanced scorecard almost in every situation that any organization I worked in. That balanced scorecard then often was, and this gets more onto the strategy side of things, but that balanced scorecard really was derived from our strategic planning documents and strategic planning process. It kind of was our report card, so to speak, that we all got around a room and discussed on frequent intervals to ensure that the metrics we're tracking that are supportive of the strategy are being measured accurately and appropriately pushed, appropriately monitored, and so on and so forth. And increasingly in recent years, we've seen these metrics translate into lean daily management or Gemba boards, where there's a linkage or clear linkage between the strategy, the key performance indicators, both financial and non-financial, down to frontline level performance and tracking on a continual basis. Okay, so depending on the organization you're in, you might see it done a little bit differently. You might see it displayed a little bit differently, but ultimately we are what we measure, and this is especially true in the financial lane. So we have to make sure that those measures that we're tracking are up in lights and actionable by those folks that have the power to move them. Okay. And to the issue of benchmarking, I've posted a number of different resources on Canvas for your use and enjoyment. I also have access to the American Hospital Directory, and that's AHD, as well as the American Hospital Association data that we basically renew every year. I use a lot in my research, but you might find useful from an educational standpoint if you want to take a look at the financial ratios, for example, for your particular area. And of course, all that data from the American Hospital Association is basically derived from the Medicare cost reports that are submitted through CMS every year and then consolidated for reporting purposes. Last but not least, a few sources for you for different ratio analysis and financial statement analysis information. And with that, I'll conclude our 4 video series pertaining to the financial statements and financial ratios. I certainly did not cover everything that's out there on this topic, but hopefully help to prompt a few questions and a few items of discussion that we can pick up on in the classroom. So with that, I'll bid you good night, and we'll see you soon.